Hi, people. Mr. Laspinato here. Want to try to give you some practice and preparation of the test, and I've got exercise 9A4, so I can lecture on the transaction as well as the implications of merchandising. That's the sale of merchandise, which you know is the company's source of revenue, which goes to the income statement. So that if you refer to the bottom of page 358 and follow along with me, I hope you'll get a better understanding or a reinforced understanding of what's going on in this area. So they start off with, it's got nothing to do with merchandising, but it appears as though they start off with an investment transaction from on October 1st, where Andrew Albright invested $2,600 in the business, and I mean that's old news. Whereby we would simply, to increase cash, would debit cash and credit Andrew Albright capital. Now, the second one, where it reads in your book, sold merchandise to on account. That's a credit sale. Invoice number one, we prepare a sales invoice and issue it to our customer, who is the buyer. Okay, and the buyer's name here is Greenfield, who's going to owe us money. The sale is for $750, so we want to bring on a debit to the accounts receivable for 750, and again the credit is to the sales account. That's the revenue account that will accumulate, and ultimately the total of which will appear on the income statement of profit and loss. Now, all of these sales, if you read the book, terms 4/10, I think they put a colon in there or a semicolon. 410 net 30. Net means the whole amount. Net slash 30. Okay, so when you all of the sales in this problem are those terms, which simply means that if the customer pays us within 10 days of the invoice date, the customer can take advantage of a discount, a sales discount, in order to encourage early payment from this guy, so that he could actually get 4 times $750, 4%, 1% of 750 times 4 looks like $30. So the guy could get $30 off of the 750 if he or she pays us within 10 days. That's a good discount, and the buyer should take advantage of it. If they don't, they're going to be losing that what I say, $30, because they have to pay the full amount by on or by the 30th day. So that if they blow it by day 10, it's going to actually cost them an extra $30 that they shouldn't have to pay. So it behooves the buyer to take advantage of discounts, because if you did it percentage-wise, they're losing quite a bit of money by not taking advantage of the discount. But what we would normally do now is update accounts receivable. We keep a ledger of every customer that we have in the subsidiary ledger, so that if you just slid down to here, you would see the Greenfield Company. Okay, from October 1st, we posted in a $750 debit from that transaction we just went over. Okay, it appears also that they're going to the control account in the general ledger for the same 750. It comes from General Journal, page 1, as does the transaction posting to the subsidiary ledger. This is the ledger where we keep track of everybody that owes us money. This is a very simple exercise. There's only 2 customers that we deal with, Greenfield and Robert. So that you're going to see at the end of the month, when we do our schedule of accounts receivable, there are only 2 people that owe us money, Greenfield and Robert. And that 1550, while I'm here, has to tie in with the balance, okay, of the accounts receivable. So you can see the general ledger, that's going to go to the balance sheet, accounts receivable as a current asset, 1550. You're going to find that in the balance sheet. And in the accounting system, you will have the individual accounts and their balances that make up that $1,550 balance, which is scheduled, all right, which is scheduled in the accounts receivable ledger, excuse me, the schedule of accounts receivable. So one of the tasks that we need, and this is also the case with accounts payable, one of the tasks is at the end of the month, when we do our trial balance, we want to make sure that we do what they sometimes call is a proof or a schedule of accounts receivable to make sure that the sum of the accounts in the subsidiary ledger are in agreement with the sum of the balance of the accounts receivable account, which is going to show up on your balance sheet. We're not going to show the individual accounts on the balance sheet. I mean, if you had 100 accounts, you certainly wouldn't want to throw every account on a balance sheet. You'd drive everybody crazy trying to read your balance sheet. So there's one number that goes to the balance sheet, but it's always supported by a subsidiary ledger. That is true. Among other accounts, it is particularly true in this module with accounts receivable and accounts payable. Okay, so let me go back to the transactions now that we've got that out of the way. Now here's another sale, debit accounts receivable. We're selling to Robert for $900. Again, I'm not going to go to the posting right now. And that's the same sort of a sale on account. That would be a term 410 net 30. Maybe I can just copy that guy and just paste it right over here, because all sales, we're offering a generous discount here of 4%, so we pop that in there. So that if you scroll down, you're going to see that 900 going to Robert's account as well as the accounts receivable account. Okay, you'll see it at the end when I review these. Now, a cash sale, you don't have to worry about accounts receivable. All you do is debit cash and credit sales. And so there's no discounts involved. There's no accounts receivable involved. But nonetheless, there is an entry to the sales account, which of course is going to be accumulated in the general ledger account along with the credit sales. So there's both cash sales and credit sales. As you can see, so far there's a total of 3 sales. Now what is often common in merchandising is the customer may have a problem with some of the merchandise. We might have delivered the wrong thing, or the merchandise is defective, or the wrong size. Under any circumstances, we contact, or the buyer contacts us, and we usually agree to a return, and we issue the buyer a credit memo, which means that we're going to credit the account receivable. As you can see here, we credit accounts receivable Greenfield Company to reduce the amount that is owed to us, so that $150 is going to be taken off of Greenfield's account. And if he started off owing us $750, as you can see here, he's going to be owing us $600 at this point after we subtract the $150 from his account. Now, this account up here is a contra revenue, and when you do your income statement, you're going to see that $150 as a direct reduction from the sales account. Again, it's referred to as a contra revenue. It's reported on the income statement as a deduction from gross sales, as is the sales discounts account. That's another contra revenue. Apparently, the Greenfield, so we're close to home here. As I said, he now owes us $600, but can only take advantage of the discount to the extent that he owes us money, and the amount of which is $600. So that what we did, when we invoiced the guy, we invoiced him for 600 and gave him the terms for 10, asking that he takes 24 bucks off the 600, so the remittance made by the buyer to us, this is a cash receipt, okay, which normally would be recorded in a special journal called a cash receipts journal. But the net amount that we received out of this sale, which actually started out at 750, but because of the return of 150 and then the discount of 24, we end up with 576. So this too, sales discount, like the sales returns, when we prepare our income statement, is going to be subtracted from the sales account. So there are two contra revenues commonly found in merchandising companies' income statements, and they are called sales returns and sales discounts. They are both subtracted. Usually you add the two of them up together and subtract the sum of the returns and the discounts and subtract the sum of those two from the gross sales account in order to get the net sales. Okay, so moving along, we go to the another cash sale that's accumulating into the revenue account, sales, so simply debit cash and credit sales. Remember, there's no services that we're selling, so it's not like fees earned or commissions earned or professional services rendered or whatever. The account for revenue is called sales. If you brought up a corporate income statement, say from Yahoo Finance page, you can go to income statements and find them anywhere on the web, and you'll see if they sell merchandise, the sales account or the net sales account is going to be the top line of that income statement. And then finally, we make another sale to Greenfield. He doesn't pay us. We don't have to worry about it, but I'll come here again and copy those credit terms, okay? Copy the credit terms. That's what they're called. Again, it could be 110 net 30, 210 net 30. It could be net 60. It could be net 45. But the first digit there represents the percentage of the discount. Okay, and you saw it in action over here when we took 2%. I'm sorry, 4% of the $600 to get the $24 offset into the sales discounts account. Okay, so those are your transactions, and I'm just going to scroll down to the subsidiary ledger. Remember Greenfield now. We started out by making a sale of $750, at which point he owed us $750. Then we credited his account for the $150. So he had at that point owed us $600. Okay, and then he paid us that $600 on the, or he paid us what we received on 10/10, as you can see here. The cash of $576 cleared out the $600 that was owed to us, and then this $650 is simply the last transaction, which is the balance of his account, because we just made that sale of $650. So that's the only thing left in his account. Robert is still hanging with the $900. Okay, he never paid us. We never granted him. He never paid us, so there's no cash receipt, and there are no reductions in his account from returns or allowances. So at the end of the day here, our cash account is going to reflect the journal entries. The first entry was the debit for the investment that the owner made. The second cash entry was from a cash sale over here. Remember the $215? So you can go back and forth, and you'll see that that's the debit to cash. There's another $576. That's from the journal entry that whereas the Greenfield paid us the $576. So that gets posted to our cash account, along with the $430 from October 15th. So you pop up to October 15th, and you can see that's where we made another cash sale. So that obviously goes into the cash account as an addition. and there are no cash collections in this exercise. If there were, you would see credits in that account. The balance of the account is $38.21, which is going to go to the trial balance and then the balance sheet. The accounts receivable here, we adjusted it every time we impacted a customer's account in the general journal. We also came into the control account to make sure that whatever was done to accounts receivable individually finds its place in the general ledger. There may be variations on how the postings get made depending on the design of the accounting system, but this is pretty basic stuff. Okay, we made a sale, we debited accounts receivable. We issued a return, we credited accounts receivable. We made another sale, we debited accounts receivable. Again, another sale, a debit to accounts receivable. And then the ultimate collection on how to get rid of this darn thing, but the ultimate collection of that 600 wiped out Greenfield's account so that the control account is reduced by that 600 bucks. And the balance of accounts receivable I showed you before is $15.50. The capital account, they just stuck it in here for whatever value. And then the sales, again, the postings in the general ledger could be different depending on the types of journals we use and the way the accounting system is designed. But certainly you are aware that the sum of all of the sales, right, for no matter where they're recorded, whatever kind of journal they're recorded in, they get to the general ledger account, so that the sales is a total of $2,945. And I told you before, that is your income statement main revenue. It's your gross revenue, as it's called, before the subtraction of the 150 and the 24. So when we do net sales on an income statement, we'd be taking what, 150 and 24, 174. What would be showing on the income statement is 2945 minus 150 minus 24. So you'd be subtracting $174 from the gross sales account in order to get net sales, which again is the difference between the gross sales and the sum of the two contra revenue accounts. Finally, to reiterate and complete the exercise here, the sum of the accounts receivable, which is $1,550, taken from the individual accounts in the subsidiary ledger, 650 and 900 equals 1550, and that figure must agree with the balance in the controlling account, accounts receivable, which is going to be on our trial balance and then ultimately on the balance sheet as a current asset. Okay, kids? Now, you'll understand the Chapter 10 problem a lot better by the concepts and procedures that we covered here. It's got to do with buying and paying, Chapter 10, as opposed to selling and collecting. So accounts receivable is usually associated and topically arranged with receipts, and the accounts payable, which you'll run into in Chapter 10, I'll do another video for you, has got to do with the purchasing and the payment for the merchandise purchased. And we're going to run into the same scenarios. If you buy something you don't like, you can return it. You may be offered a discount on what you pay, and that's going to reduce the cost of your purchases. So this gives you kind of a combined background for both of the chapters in the module. Okay, but be sure when you go through this, be sure to read and go through each transaction so you can see the narration and you can see and then listen and follow my explanations through. Hope this helps you, and I'll talk to you real soon. Thank you.